where does 5.4 come from?
Yeah.
We're, by the way, in a range now of 4.5 to 4.75.
Correct.
You know.
So once every 3 months, each FOMC, Federal Open Market Committee participant, needs to submit essentially a forecast of what we think optimal monetary policy will be and how the economy will respond. And it's a tough thing. Once every 3 months, we have to write something down. And we have a lot, I'm sure Susan does this with her colleagues, a lot of deliberation with my economists at the Minneapolis Fed on what do we think the underlying trends are for inflation, how responsive do we think the economy is going to be to our rate hikes, how long does monetary policy take to work its way through the economy. So there's a lot of judgment and art in addition to attempts at science to try to put down something. And basically, last year, I concluded, and I think many of my colleagues concluded, that the traditional economic models that we rely on to understand inflationary dynamics have really failed in the reopening of the economy. We did not see, just to be blunt, we did not see the giant inflation coming, and we did not expect it to last as long as it did. As you might recall, many of us said we thought it would be transitory. Well, what we ended up having does not feel like transitory. So once I concluded that, hey, these models are not working, then how do we still have to make decisions. How do you make decisions if your fundamental tool is not working? Well, we have to let the inflation guide us. And it's raising rates aggressively to try to get real interest rates positive. It's unlikely that negative real interest rates would be restraining the economy. So we need to get real positive interest rates across the yield curve, get there as fast as we can, and then watch inflation and see how inflation responds. And so far, headline inflation has come down because oil and food prices in many cases have come down. Core inflation has come down because goods prices have fallen. But the services side of the economy is still hot. And we know housing inflation is a big part of that, but we can actually analyze and forecast housing pretty well. If you look at new leases that get signed, it takes a year or two for them to work their way through the official inflation statistics. So if you strip out housing, you're left with this part of the economy called core services X housing. Think about the services economy, the wages that people are paying and people are earning. We haven't seen any movement there. And so there's some hopeful signs, but there's not yet much evidence in my judgment that the rate hikes that we've done so far are having much effect on the labor market. And we need to bring the labor market into balance. So that tells me we need to do more. How much more? I don't know for sure.